Okay, so I'm getting a lot of comments about QYLD. A lot of people like this closed-end fund for its high cash flow, and I'm getting a lot of comments talking about its cash flow in this one, for example. But there's a lot more. There's this one. This guy kind of leaves a long comment talking about why exactly is QYLD bad. Down here's another one saying if you're not spending the money from QYLD dividend, you can reinvest it back in and it compounds. It's misleading to say you're down 6%, which is what I believe I said in the video. So, okay, a lot of confusion with this ETF. So let's go through a little presentation I made on it. And disclaimer, I don't have any money in QYLD, but I don't have any bias. I mean, it is what it is. I'm in the game to make money, and I'm sure all of you guys are too. So, what is QYLD? This is from the official website, and this is a little synopsis on what's going on. And right here, quick little bullet points, QYLD's covered call writing process. Number 1, QYLD buys all the equities in the NASDAQ 100 index, so they replicate the NASDAQ. Okay. Then they sell NASDAQ 100 index options to a counterparty that will expire in 1 month. Number 3, a premium is received in exchange for the sale of the index options. Number 4, at the end of the month, QYLD seeks to distribute a portion of the income from writing/selling the index options to the ETF shareholders. Number 5, at the beginning of each new month, the process is repeated. Here's a little diagram, but that's it. It's automated. It's very simple. It's rinse and repeat every month in the call options, and it's the same thing over and over again. Now, of course, we got to do some more digging because on the surface, that really doesn't tell you that much about the ETF and what to expect from it if you're not super educated in that specific field. So there's a bunch of articles like this. I didn't cherry pick this one. It's just this one was the best written, in my opinion. And I highlighted a few things that he talks about here. It's a very long article. I'll leave the whole thing linked down below. I'm just going to skim it in a few highlighted sections here. So he begins by breaking down the type of people that would be interested in this ETF to begin with. The first type is those seeking immediate income. So of course it has a super high yield. It's like 11.5% right now. And he says that a lot of people refer to this as a bond substitute. And he doesn't like that comparison because since the inception of this fund, it has lost over 10% of its value. And of course, with bonds at the end of the period, you're supposed to get your capital back. So this doesn't act like a bond, although it does produce cash flow, much like a bond. Now, this visual right here is showing the dividend yield over time. So you can see it's a very high yield, although it has dipped below 8% in the past, and it definitely can again. And then down here, of course, is just the price of the asset over time. Now, this next one is actually really fascinating, especially because it's all about the income. So it says this next chart shows QYLD's monthly distributions from a $10,000 investment at its inception, with income withdrawn at the top and with income reinvested at the bottom. This is exactly what that comment on my channel was talking about. So at the top here, these are just the distributions if you take it and you live off of it. And down here, you can see the compounding effect if you reinvest the payouts. So clearly there is a benefit to letting it compound. If we come down a bit further in this article, he talks about the second group of people looking to invest in QYLD. And these are the people that don't need the income right now, so they're not retiring, but they want to let it compound and eventually have it as an income source in the future. So essentially they're focusing on total return. And he basically goes on to say that those building capital to generate income in the future, QYLD is an exceptionally poor vehicle for that end. So if you're looking at this for total return and taking income in the future, he's saying that QYLD is super inefficient for that. So for that first group of people that are retired right now and need income today, you might want to look into QYLD. It might not be the worst thing ever. I would recommend looking into other funds that do similar strategies and see how they perform over time. You know, when do they crash? When do they do good? Stuff like that. But now the second group of people, which I think is most people, especially on YouTube, they're younger and they want to reinvest the dividend, let it compound, and have the most cash flow possible in a few years. Now, QYLD is not good for this. Right now, we're looking at the 5-year or since its inception back here in 2016, and we can see it's been flat. In fact, if I do the exact measurement here, we can see that it's up 1%. But of course, people are going to say that it's all about the income, so sideways movement is actually a good thing as long as it doesn't go down. So we can actually look at what the total return looks like. So this is a graph of the total return of QYLD based off of a $10,000 initial investment. And we can see that if you had an initial investment of $10,000 since the beginning of this investment vehicle, you would have a final value of $17,000 with an annual return of 8%, roughly speaking. All right, so right there, that's a lot better than just looking at the capital appreciation. So the payout really does make a difference. Now, let's compare this versus, I think I got SCHD right here. And keep in mind, we're talking about that second group of people that aren't retired today, but they want to just have the maximum amount of cash flow at some point in the future. So this is SCHD, same exact thing, beginning with $10,000, dividends reinvested, and we can see the final value is $40,000 with an annual return of 15%. So this is why QYLD isn't amazing for total returns. And of course, total returns includes reinvesting that hefty dividend. Okay, quick pause. I gotta do a quick correction because I had the dates a little bit messed up because QYLD isn't 10 years old. So I had to adjust the starting date to 2016. And we can see here that with QYLD, initial deposit of $10,000, final value would be $15,000 with an annual return of 10%. Doing the same thing with SCHD. The $10,000 turns into 21 with an annual total return of 18%. So numbers are a little bit different, but the overall concept is the same. Now the pain doesn't stop there for QYLD because if we look at SCHD, this is a traditional dividend ETF, and the dividend goes up over time. So we can see 10%, 7%, 19, 17%. So let's just say that the average growth rate of this ETF is 10% per year in dividend growth. And keep in mind, QYLD doesn't have any dividend growth qualities to it. It just pays out whatever it can. So this is another dividend calculator. We can see I kept the initial principal the same, $10,000. I just kept this as simple as possible, and I had the expected annual dividend increase of 10% per year. I've calculated the dividends, and we can see right here that at the end of this 10-year period, you have a yield on cost with SCHD of 35%. So best case scenario, QYLD continues to go sideways, paying out that 11% per year, which is going to be an annual return, total return of 8%. While something like SCHD is going to offer a lot more total return, 15% per year. And when you consider that growing dividend, it's going to give you a yield on cost that's going to surpass QYLD relatively fast. Come back to this article to kind of round out the video. There's 3 paragraphs I want to read here that did a really good job summarizing what QYLD is all about. So I just want to read it, and I think it's going to benefit you guys. So QYLD's calls are written at the money each month to expire the following month. At the money calls generate high premiums, but if the underlying index gains at all over the course of the month, those gains become liabilities for QYLD. If the index gains more than the fund has taken in as premiums, the fund has a negative cash flow on the option. Okay, the rest of this paragraph actually doesn't matter, so moving on to the next one. What this all means is QYLD is effectively designed to not have capital gains. Return to its investors comes from the options premiums. Other covered call, also referred to as buy right funds, generally approach their option strategy differently in one or two ways. Some write call options out of the money. This gives those funds some opportunity for capital growth, but it also means lower premiums and therefore lower distributions. There's always a trade-off, right? That's the thing between capital appreciation and dividends. You can either max out on one side or the other, but there's always that trade-off. Continuing, it says, QYLD's management has opted to maximize income from premiums and minimize capital growth. And while some write calls on 100% of their portfolio value as QYLD does, others only write call on a portion of their portfolio. Again, this leaves an opportunity for capital growth, but limits the income earned for distributions. So I hope that gives you a better idea or just an understanding of what's going on with QYLD. I'm not here to hate on it. And you gotta remember, there's 2 groups of people, those that need income right now, and for those people, QYLD can be very appealing. And then there's those that want to let it compound a little bit and eventually tap into it, and they think that just going straight into QYLD is the best way of doing that. And unfortunately, when it comes to total return, which is exactly what you're talking about in that situation, QYLD simply isn't the most efficient option in doing that. To finish off the video here, this does an excellent job of just showing what I'm talking about. So this top line is SCHD. This is the classic dividend growth portfolio or ETF. And you can see it's done the best. This has a 3% dividend yield, roughly speaking. Down here is an enhanced dividend ETF. That's an ETF that I actually really like, and they try to generate additional income with options. And we can see the performance is less, and the dividend yield is like 4.5% right now. Below that is JEPI. That has a dividend yield of around 7%. And then down here is QYLD with a dividend yield of that 11 to 12%. And we can just kind of see that perfect relationship. The higher the dividend yield, the lower the capital appreciation. And because QYLD goes to the extreme of focusing 100% on just distributions, they do suffer when it comes to that total return. So that's the end of the video. Hope you guys enjoyed. If you did, leave me a like, and I'll see you next time.